Hi, everyone. My name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to this special InvestNow webinar. This is the first in a series of workshops that InvestNow will run over the coming weeks that are designed to help Kiwi investors better achieve their financial goals. It's not surprising that the world of investing can seem complex. Investors today face often changing market conditions, and in the supply of market news and many investment choices. So how do Kiwis ensure that they are approaching investments in such a way that they are building towards long-term success? Well, the good news is, no matter if you're completely new to investing or a seasoned investor, by focusing on investing fundamentals and having the right investment mindset and approach, success is largely within an investor's control. So we'll go back to basics today and ensure that we get the foundation right in today's InvestNow workshop, Investing 101. So on the agenda today, we'll be introducing the InvestNow investing principles and focusing on 4 of those principles in particular, which will shape how you view and approach investing. We'll then go in and see how you can apply these valuable lessons from these principles into your investing journey before opening up for a Q&A at the end. So if you have any questions, please do fire them through in the chat box and we'll try and get through as many of them as we can. Just for some housekeeping though, please know that everything that I will be discussing here today is just general information and purely for educational purposes only. Neither I myself nor InvestNow provides any personalized financial advice. However, we are strong advocates for it and we actively promote the benefits of seeking personalized advice from qualified advisors. So with that out of the way, let's jump into the workshop then, shall we? And the first thing we want to introduce is InvestNow's 10 investing principles. These are our guiding principles that is intertwined in everything that you do to help guide Kiwi investors towards long-term investing success. Investing principles. Each of these 10 principles has an important investing lesson embedded into them that is stuff that is so fundamental that it applies to complete novice investors alike to someone that's a seasoned 90-year investor like a Warren Buffett. Today, we'll focus on the foundational investment principles. These are the principles that shape your mindset and approach when it comes to investing as a whole, and why should we invest and how should we be approaching the investing journey. These are codified in the 4 principles highlighted in that top row, which is to invest now, have a plan, stay informed but don't react to the noise, and ensure that investing is not a game. So let's kick into that first investing principle, shall we? Invest now. This investing principle is so important, we had to name our whole business around it. So what is the Invest Now investing principle? So this is all about emphasizing the importance of starting your investment journey as early as possible, because starting early is one of the most tried and true ways to successfully build wealth over the long term. This is because the earlier you start, the more time you are invested into the market, and that enables you to take advantage of a little thing called the power of compounding, which Albert Einstein famously coined the 8th wonder of the world. To put it simply, the power of compounding or compound interest is the snowball effect when the returns that you generate from your original capital investment get reinvested and generate even more returns for you. Over time, the investment returns become a bigger and bigger portion of your portfolio relative to the capital that you put in, and just continues to snowball over time and can turn even modest original investments into substantial wealth. That's the beauty of this first invest now principle. By simply starting early, you don't necessarily need a whole lot to work with in order to build and generate substantial wealth. Some of the most successful investors in the world also started from humble beginnings, but by sticking to a tried and true investment principle and doing so over time and allowing their money to compound, they've multiplied their wealth significantly. Let's have a look at the power of compounding in action then. So let's take the simple example here where we have 5 different investors that start their investing journey across different time frames. So we have someone that starts the investing journey at age 20, someone at age 30, 40, 50, and 60. And they all have the same goal of saving for retirement at age 65. So let's see what their retirement nest egg actually looks like at age 65 based off a few assumptions we've used here. So one is that all these investors will generate the same 7% return each year that they're in the market, which is basically the same and aligns with the long-term average return that many Kiwis have at diversified growth funds sit around, which is usually the key kind of instrument that we use for building towards retirement nest egg. The second key assumption we'll use is that each investor only ever invests a total of 180K into the market over their entire investment time frame, split up evenly each year. So obviously for an investor that's got a lot more time, then the amount involved is a lot more manageable with just $4,000 a year that they need to invest if you were to start investing at age 20. Again, we've gone with these numbers that are fairly close to what someone working full-time, even on minimum wage, would be able to contribute to KiwiSaver, for example. So based off a 3% rate of, 3% contribution rate, 3% employer contribution, and 500 top up from the government each year, you get pretty close to 4,000 already. So let's see these numbers in action then. So you can see that for an investor that starts their investing during age 20, even though they've only invested 180K, same as everyone else, by virtue of investing earlier than everyone else and letting the returns that they generated in those early years fuel greater returns in later years, the age 20 investor is able to generate over $1 million extra in returns compared to someone like the age 60 investor, purely by being invested in the market for longer. Or roughly, for the age 20 investor, 85% of their retirement nest egg comes from money that they generated from the market, and only 15% comes from money that they saved themselves. He's managed to multiply his wealth by 7 times. If you compare that to someone like the age 60 investor, they have 1 million less that they've generated from the market, and they've barely multiplied their wealth, increasing it by 1.2 times. So most of the nest egg has been from their own contributions. 180K, or around 80% of their 220 nest egg portfolio, is from their own contributions. So this really highlights the importance of investing early. Even if you would invest later, like someone like the age 30 investor, they just only started their investment during 10 years later, but their investment gains is a whopping basically cut in half. So the age 20 investor generated 1 million, the age 30 investor 500 something K. So even those 10 years can make quite a significant difference and really highlights the exponential benefit you get of every single year that you start early. The rough intuition is that somewhere in the region of 70 to 80% of your wealth can be generated from those last 25% of those years that you're investing within your time frame. So that's how exponential it is if you allow the power of compounding to help you. But if you're investors like myself, where your 20s are already in your rearview mirror, don't fret that you feel like you're already behind the ball and there's no way to make up. As ultimately, it doesn't really matter what time you invest. All that matters is how long you invest for. So for someone that invests from age 20 to age 60, they can access the same power of compounding as someone that invests from age 30 to 70, because it's all about the investment time frame. Obviously, the earlier you start, then the longer time frame you have, because us as humans, we eventually have an expiry date. But as long as you're invested in the market, that's the most important thing there. Good example is Warren Buffett, for example, one of the greatest investors of all time. He averaged crazy returns of roughly around 20% each year. There was some math done behind it. If he had stopped investing at age 60, then his estimated net worth would only be around $12 million today. And look, I wouldn't complain if I was worth $12 million. It's still amazing. It's still generational wealth. But because he kept investing until his current age was nearly 100, it's that 12 million is worth a staggering 99.99% less than his current net worth of 140 billion. So that really highlights just how crazy the numbers get if you just keep investing and compounding over time. So Warren Buffett has been compounding for something like seemingly 80 years. Cool. So next one that we want to touch on in terms of the investment principles is the age-old adage. So the principle here is have a plan. It's really an offshoot of some age-old wisdom that if you fail to plan, then you plan to fail, right? Because investing decisions ultimately reflect a range of factors such as risk tolerance and time horizon. And a key to a successful plan is to set appropriate investment goals, which are clearly defined, realistic, and carefully balances out your investment objectives against your investment constraints. So your investment objective is what you want to achieve with your money. This is personalized to your specific needs, but it could be something as simple as I want to retire 5 years early, or I want to retire with a nest egg of $1 million. In contrast, your investment constraints outlines the conditions your objectives must be achieved under. A key constraint, for example, is your ability to save or invest, both in terms of money you can contribute, but also the amount of time you can start investing from. Another key constraint would be your time horizon. Generally speaking, the longer you have time to invest for, the more you can invest into growth assets like shares and properties. And over time, because over time, the longer your time horizon is, the more you're able to ride out any volatility that those riskier assets have. Equally, a constraint could be your risk appetite. If you're someone that's not comfortable taking a lot of risk, you may prefer to invest into something safer, like fixed interest assets, like cash and bonds. So based off your objectives and your constraints, when your goal would emerge, right? So if you had an objective to retire 5 years early and you want to retire for next year with $1 million, but you had some constraints saying, you had a relatively low risk appetite, you want to invest in something safe like fixed income, but you only had $500 or so a month to invest, then your goal would be to retire by 60 with $1 million by investing in a portfolio of fixed interest assets. Your plan would be an offshoot of that. So your plan would then be you want to start investing $500 a month from age 20 into a mix of fixed interest assets. Based off a roughly 5% long-term return that we see a lot of global government bonds, by starting at age 20, investing $500 a month, you get pretty close to your 1 million by age 60. So what are the factors that a robust plan makes? Well, first off, it should be really tailored to your individual needs. So although we may all have very similar end destinations, key example being we all want to have a comfortable retirement, how we each go about reaching that final destination will be different, as we all have different investment needs, we all have different values, and we all have different priorities. A simple analogy would be two people going on a trip from Auckland to Wellington. For both, the end destination is the same. Just want to get to Wellington, right? But for the first person, maybe the most important thing would be speed. They go into Wellington for work. So the most important thing is to minimize the amount of time they spend traveling, and they'll go by airplane. Second person, they may want to go to Wellington, but their goal was leisure. They want to take their time, enjoy the scenery, maybe their plan would be they'll take a car, take a road trip down, enjoy the gardens at Hamilton, the spa in Rotorua, a bit of wine in Hawke's Bay. Eventually, they'll get to Wellington as well. So again, the same destination, but completely different routes, right? So that's the key thing there we want to highlight is you really need to cater your plan to your individual goals and your individual situation. So the other thing to kind of consider with building a plan is prioritizing those goals. So as humans, we may have multiple goals on the go, especially over different time frames. For example, short-term goal may be saving up for that nice holiday. Medium-term could be saving up for those renovations. Long-term could be saving up for a long, nice retirement, right? But equally, each of these goals always kind of always require us to fund them from one kind of single pool of assets, which is generally our income, right? So we need to ensure that we allocate these finite pool of resources towards each goal based on their importance. Other thing to keep in mind when building a plan is to really understand your risk tolerance. So risk tolerance isn't just your appetite and view towards risk. It's also incorporates your ability to handle risk, right? So although you may be someone that's very outgoing, very adventurous, wants to invest into every single risky asset out there to generate as much gain as possible, you may actually not have a very high risk tolerance because if your investment horizon is very short, or you don't have a big safety net, or you don't have much to contribute by way of investments on a regular basis, then your risk tolerance, irrespective of the fact that you want to take on higher risk, your risk tolerance will still be very low. So the key thing there is to remember that you always want to plan and invest according to your risk tolerance, because that's your ability to handle risk, not what you think you can handle. And then finally, the other key thing to keep in mind is that investment decisions, they reflect a lot of our human objectives, right? So your own personal values and beliefs can impact your financial goals. So a key example would be, if you are someone that wants to save the world or feel that they're quite green, then you want to potentially invest in something like more ethical funds, right? That screen out certain industries like coal and tobacco and fossil fuels, et cetera, et cetera. So consider, how non-financial factors may actually impact your financial plans and goals. Moving forward a little bit, let's go to the third investment principle here, which is to stay informed, but don't react to the noise. So especially in the 21st century, we're glued to our phones all the time. There's just so much market news out there, so many headlines telling you to buy this, telling you to sell that, telling you the market's going up, telling you the market's going down. How do you know what's actually informative and what is noise, right? So we've got a couple of helpful hints here. So in terms of things that are informative, investors should really try and keep on top of stuff like key market developments. So this isn't necessarily following markets every single day and seeing what's going up and down. This is more seeing things at a macro level. Stuff like, for example, New Zealand's central bank or the US central banks recently looking to, cut interest rates. So potentially that changes the outlook of equities versus bonds, right? So those are kind of major market events. It's always good to kind of keep on top of. And it kind of relates to the second piece there around any changes to your underlying investment. So, if you're investing into funds, for example, the underlying manager is always constantly tinkering with their portfolio, potentially even changing the investment strategy altogether. So it's always good to kind of review your underlying investments and make sure that the investment strategy and the goals that the underlying manager is seeking to achieve still aligns with your personal circumstances. And really that loops into the third key thing about regularly reviewing your situation and your financial plan and journey and goals, because we as humans, we're constantly changing, like we go through different life stages all the time. If you're someone that was saving up for a house deposit, for example, and you obviously if you need the money access, if you need access to that money earlier, you would be wanting to invest into more conservative stuff like cash and bonds. Whereas once you buy that house, then all of a sudden your entire personal circumstances and financial circumstances change. Now all of a sudden you've got plenty of time before you're going to retire again, in which case you could look to then feed back into stuff like shares and property. So regularly reviewing your portfolio and your situation is key as well in terms of being informed. Noise is, we see plenty of this, stuff like overcooked headlines, so many headlines that say, there's so much fear, there's so much uncertainty, so much fear mongering, scaremongering out there to try and get you to sell as soon as possible, or try and get you to buy, otherwise you're going to lose out on XYZ. So be very, very wary when headlines are trying to call for emotional reactions from you. As prudent long-term investors, we don't want to react emotionally to things. We want to potentially respond to things, though, if there is anything that we need responding to. So be very wary of that. Also be very wary of placing too much emphasis on short-term performance. So it's very key that markets, as part of the investing journey, they're constantly fluctuating, especially over the short term. So we saw that clearly last month. Markets had a moment in early August, everyone was crying and saying that the bear market's here again, and all of a sudden it's recovered by the end of the month, and markets actually went up, in the month of August. So markets fluctuate all the time, and just being very conscious that you're not making long-term investment decisions based off of short-term volatility, because there's plenty of textbooks evidence of this as well. Investors that stay invested over the course of different market cycles tend to do very, very well, despite there being volatility throughout. And then finally, if you read a lot of headlines saying promising high risks, promising high returns, basically risk-free products, then be very wary of that. I know there's probably been a few recently in the headlines that's even got the FMA's attention. So be very wary if you get, promised like 10%, risk-free returns on your Facebook or Instagram scrolling. Usually investments that are too good to be true typically are. So be very mindful of that. And let's see, an example of, staying informed but don't react to noise actually gone wrong. So we saw, for example, during the big COVID crash, when, basically the world went into lockdown, that markets had another moment, basically from a 4-month period of March 2020 to July 2020, markets crashed, went down something like 20-something%. And then every headline, even New Zealand, was saying that we need to go to cash. If you're in KiwiSaver, change from growth to conservative. We need to protect your portfolio, protect your wealth. What actually happened, though, is finds out markets ended up bouncing back, and investors that stay invested the whole time, or if you're a KiwiSaver investor, you remain in your growth asset, your growth fund or your balance fund the whole time, then they were able to basically maintain a solid track record and return 21% at the end of the 5-year period ending 2022. For some investor that reacted to those news headlines and simply went to cash for those 4 months within the 5-year period, then basically their 21% return went all the way to -2. So they lost money simply by going to cash within a 4-month period in a 5-year window. So it doesn't take a lot of reaction. It doesn't take a long reaction. It doesn't take a lot to basically eradicate a whole, 5 years worth of gain. So be very, very mindful when you read a lot of headlines about making drastic changes, especially if you're a long-term investor. Then there's no need to be worried that there's some short-term fluctuations. Long-term investors, they usually can ride out that volatility. And probably the final thing that we will touch on, and our final investing principle, is to just really treat investing as, for its serious nature, because investing is not a game. It can be very entertaining, very emotionally rewarding, but at the end of the day, money is quite serious, and losing it is not fun. So investors can really have the right mindset and the necessary rigor and discipline that investing demands by doing stuff like investing into regulated products. So, for example, InvestNow, we only ever deal in regulated products. So these are, either regulated by the FMA in New Zealand, the Financial Markets Authority, or ASIC in Australia. So all of our funds, there's kind of countermeasures, there's supervisors involved, there's measures in place to ensure that investors are looked after, and the fund manager must always kind of take the investors' considerations into account and look after us. Another thing to be very mindful of is that we as humans, we're quite emotional. There's a whole lot of gamification these days, and apps trying you to bet more, or kind of invest more, sell this, sell that. It's a whole bunch of behavioral biases that we are very susceptible as humans. So just making sure, and kind of going back to that second investment principle, having a plan means we can kind of ride out any of those temptations and kind of stick to our long-term investment journey. Probably the third thing just to kind of touch on there is just generally treating the whole investing journey or financial journey quite seriously. It's kind of like akin to taking your health quite seriously. So we're all busy people, and for a lot of people, myself included, it's hard to like take health as our priority sometimes. But you really need to kind of take this journey seriously, because if we look after our health or look after our money, then they will look after us, right? So we really want money to work for us. We don't want to be working for money, for the rest of our lives, kind of thing. Eventually, all of us want to retire comfortably into a nice lazy boy, right? So really treating it with the rigor and seriousness that it deserves. Investing is not a TAB. It can seem like gambling sometimes. It can seem like you're just having a lot of fun. It can seem like chucking $20 on the All Blacks this weekend. It's not the same thing. There's a lot of textbook research on this. If you stick to these sound investing principles, then you will do well over time. So that's probably the final thing in terms of those investment principles. The final thing that I'll probably end with is just how we can actually apply some of these principles to action today, right? So the first most important thing, if you learn nothing else from the session, the most important thing is just invest now. So if you haven't already, kickstart your investing journey today and take advantage of the power of compounding. We saw the riches on offer. So InvestNow is purely designed around these principles, and we offer something like 160 different funds and term deposits from 6 different banks. So there's something for everyone in terms of what the investment suite that we offer. So get started today if you haven't already. If you're already investing, then the other thing to take away from this is review your investment strategy. Even though you may have set it up a while back, we're constantly changing. Markets are changing. Your personal needs are changing. It's always good to review your investment strategy and make sure it's still fit for purpose and aligns with your personal needs and investment goals. And then the final thing, in terms of the most pragmatic I can probably suggest, is establish a regular investment plan if you haven't already. It's the same thing as like KiwiSaver, basically. The reason why KiwiSaver has done so well is basically it's a set and forget type approach. Just money consistently falling into it has made it grow into a $110 billion kind of scheme to help New Zealanders save their retirement. Same thing you can do outside of KiwiSaver as well. The benefit of setting up a regular investment plan outside of KiwiSaver is you can have access to that money before 65, or before you need to buy that first house, right? As long as you're someone that has a bit of discipline, it can actually not tip and touch that money until then, and just let it regularly snowball. Then it makes sense, for example, to minimize your KiwiSaver just to get the government contribution, just to get the employer contribution, and invest the same money you would have in a non-KiwiSaver fund that does the exact same thing. Then if you want to retire early, it's all up for grabs. So that's the end of my prepared slides. Super happy to take any questions if anyone had any. Got a bit of time, so we'll try to get through as many as I can here. So let's have a look. Just making my way down. So it looks like that person fixed their sound issues, which is good to go. So is this going to be uploaded to YouTube? Yep, yeah, that's definitely the plan. So this is all recorded. So off the back of this, if you've registered, then you will get a copy of this recording, but we'll also chuck it onto our YouTube channel as well. Let's see, is it possible to have a copy of the slide deck? Yep, so it looks like we've answered that question already. We'll be sure to send that through to you. See, starting at age 40, if the monthly disposable income for investments $5 was the most reliable funds to invest in for both long-term 20 plus years and short-term like 5+ years. Yeah, it's a good question. So it's a question around, what funds should you invest in? So again, just to really highlight, we don't give financial advice, so we can't tell you exactly what funds to go into. But what we can do is kind of give you some guiding principles around how you select funds and investments to match your kind of risk tolerance, to match your goals, to match your overall, investment objectives. They're probably not so much of a focus in terms of this webinar. I did mention that there's going to be a series of workshops. So the next one that we are going to be touching on in the coming weeks is portfolio construction. So that's stuff like going back to the investment principles that we have. It's stuff like, if I actually go all the way back to, hopefully I can find it here. The very first investment principle page, we've got individual risk tolerance matters, understand the risk, investor styles and complementary, asset allocation is almost everything, and diversification is essential. So in this next webinar, we'll be talking about how you can actually construct a portfolio to match your goals and to kind of best place you for long-term success. in terms of something that if you're starting at age 40, if you're retiring kind of at 65, then generally speaking though, and we just talk high level here, going into something like that's heavy in growth assets would tend to do you well. So growth assets would be stuff like shares and bonds. Popular options on the InvestNow platform will be something like the S&P 500 or some global shares bonds, which are 100%, sorry, global shares funds, which are 100% invested in, around the world. Generally speaking, stuff like that have returns, between 8 and 10% gross year on year. So generally speaking, even if it goes down, 20% like it did in 2022, you should have enough time over a 20-year horizon to make up any difference. Over short term, we'll generally steer investors towards stuff like fixed interest, like bonds and cash, because if you really need money within 5 years, there is always the chance that the markets will be volatile by the time you invest, and that if you need it within 5 years' time, you definitely don't want your portfolio to have gone down during that time. So safer assets like bonds and shares. But again, we'll go into more detail probably in that second workshop. See, do you have any 10 to 20 year predictions, Indian economic growth, etc.? Yeah, again, we're not trying to do, my crystal ball is a bit hazy these days, so I don't have anything out 10 to 20 years. I don't think even probably the best investors, the smart people in the world, probably don't have a whole lot in 10 to 20 years. I think, just talking high level in terms of India, it's definitely one of the growing powerhouses in the world. I think it's already, bigger than China in terms of, population growth, and, the Indian stock market has done basically gangbusters recently. We've got one Indian fund by the name of the India Avenue Global Equity India Avenue Fund on our platform. So, the portfolio manager, Maguntha, probably be a lot better place to talk about this stuff than me. So I can definitely get you in contact with him, and maybe potentially we can even do a webinar one day with him to kind of talk about what's happening in India. But yeah, it seems like it's going to go through one of those similar China stories where, it becomes one of the big kind of drivers of the world. Cool. So sorry, I couldn't really answer too much in terms of the crystal ball stuff. But next question, do you have any thoughts on investing on something like Vanguard and dealing with fifth rules, or investing in something like the Foundation series of simplicity? Yeah, so we've got plenty of thoughts on this stuff. So particularly around kind of tax efficiency. So again, this will probably be something that we'll discuss in the following webinar after portfolio construction, which is around optimization. So that's stuff like talking about fees and tax and how important it is and how it impacts your portfolio. But at a high level, I would say that if you are an investor that is on a higher marginal tax rate in New Zealand, so something like 30, 33 or 39%, then there are benefits of going into a fund that has a pie structure, because they do cap your applicable tax rate at just 28%. So there's savings there. Equally, there are potentially, some administrative savings around not having to file a separate tax return every single year. Additionally, there's some additional stuff like tax leakage to consider. So tax leakage essentially is, to explain it in a simple way, every time that a company or a fund pays out dividends, then there's a bit of withholding tax that is withheld from those dividends to pay the local tax jurisdiction. If a fund is not properly structured efficiently tax-wise, then rather than being able to claim back those dividends as a tax credit when you end up paying your taxes, they get lost because of the structure of the funds. So an example is the Vanguard Australian unit trusts that that are available. They have a little bit more tax leakage compared to something like a pie fund from Foundation series or Simplicity. So some things to keep in mind, but ultimately it really depends on your tax, on your situation. You may be on a lower tax rate, and ultimately the Vanguard funds versus Foundation series Simplicity invest in different stuff as well. So, if they perform differently, net after tax, and it may be a different story anyway. So happy to go into some further detail as well in a subsequent workshop. But again, if you have any further questions on that, feel free to flick me a bell, which I'll give my contact details at the end, or our customer service team. Cool. And then next question. Sorry, just trying to get through as many as possible here. Could you explain the difference between rebalancing and changing strategy? Yeah, this is a great question, actually. So rebalancing is basically you're keeping the same investment strategy or the same mix of investments, but you're simply bringing it back to how you had initially set in terms of your target. So for example, if you wanted a balanced portfolio, right, something like you want to invest in 60% in stocks and 40% in bonds, which is typical, stereotypical balance fund. Over time, because of market movements, if stocks go gangbusters, if bonds, have one of their days where they're not doing so well, then that 60-40 split may over time go back to 70-30. So all of a sudden, just purely due to market moves and not due to anything you've done yourself, you may all of a sudden be taking on a lot more growth assets or a lot more risk exposure than you had initially wanted. So then in that case, you would want to rebalance it back. So sell some of your stocks and buy back some of the bonds. So you go from 70-30 back to 60-40. So that's rebalancing. So nothing's actually changed there. You're still investing in the same underlying securities. It's just you're rebalancing back to what you had initially targeted. Changing strategy altogether is different though. That's if you wanted to change, basically go from a different risk profile altogether. So rather than going a balanced strategy of 60-40, you wanted more growth altogether. So you'd sell everything and basically go into something like an 80-20 split, 80% in growth assets like shares and property and 20% in bonds, because you realized you actually had a lot longer investment horizon, or you had a bigger risk tolerance than you thought, and basically you're changing strategies altogether. So in terms of rebalancing, we generally recommend at least doing that annually, because markets can move quite a lot in any 12-month period. Whereas changing strategy, it's always good to review annually, but in terms of change, you should only really do that if anything's changing in terms of your personal circumstances. So if your ability to take on more risks has changed, for example, you're a long investment horizon, or you got more money to be able to save up, or you're all of a sudden you no longer need to save up money for a house deposit, you want to just focus on retirement, all of a sudden that's personal change that warrants potentially reviewing your investment strategy and potentially reviewing changing your strategy altogether. Cool. So next question, just conscious of time a little bit. I know we did have half an hour kind of pegged for this, but if anyone wants to stick around, then I'm happy to answer as many questions as possible. I do know we've got quite a few here, so I'll probably just try to stick around for a little bit longer. Cool. Next question, does InvestNow provide any personal financial advisor services for strategy review? So we don't provide any financial advice at all. We're not licensed to do that, but we do work with a lot of financial advisors. So if you did want, for us to put you in touch with a specific advisor, feel free to give us a bell, contact our customer service team, and I'm sure we can find someone in your region or someone that could fit your specific circumstances. Just on the last bit you mentioned is investing. Next question. Just on the last bit you mentioned is investing directly in individual funds better than doing so in KiwiSaver. So I guess in terms of better or worse, so usually in KiwiSaver, if there's a KiwiSaver fund available, usually the fund manager will also make that same fund available outside of KiwiSaver. So it's not better or worse, it's the exact same fund. So it's purely in terms of you could have some advantages of investing into the same thing outside KiwiSaver, because purely within KiwiSaver, you could only only access it until 65. If you wanted to retire early, for example, then you wouldn't be able to do that if you chucked everything to KiwiSaver. So just be conscious of that. Obviously, the downside is if you are someone that is not very disciplined and you can always touch it, then you're better off just chucking everything into KiwiSaver, because then at least it's ring-fenced, and you won't be able to touch it until you actually need it and be able to actually let it compound. So unfortunately, I think that's about the amount of time we had today. I know there were quite a few more questions. So what we'll do is we'll reach out to the people involved and answer them. And equally, we'll also provide our contact details. So off the back of this webinar, feel free to email either myself or our customer service team. We'll be more than happy to help. We'll make sure to include that as long with the slide deck and a link to the recording. So, final message, we hope you found this informative. We really want to help our investors take control of the investment journey. And if you want to learn more, please do check out the InvestNow Investing Principles, and we'll be in touch with further workshops. Cool. Thanks so much, guys, and we'll catch you in the next one. Cheers.